Welcome back to Quest Meets Business. U.S. stock markets falling sharply after the Minneapolis Fed president said it's possible there will be no rate cuts this year. The Dow turned sharply lower. It lost over 500 points. Neel Kashkari said he had anticipated 2 cuts this year. He went on to explain that if inflation kept moving sideways, he'd question whether the Fed needs to cut rates at all. He said raising rates further is unlikely. Art Hogan is the chief market strategist at B. Riley Wealth Management, and he joins us now from Boston. He also said that no rate cuts is not his base case, and we also have to add a disclaimer that he's one heck of an inflation hawk. But it was a reality check, I think, for investors, Art.
It certainly seemed to be. And, we've had 20 Fed speakers, or there's 20 Fed speeches scheduled for this week. So we've certainly been on a roller coaster of will they or won't they in terms of rate cuts. But I think the important thing is the market's gotten much more comfortable with fewer and later cuts. At the beginning of the year, we thought there'd be 6, and the first one would be March. Now we think there'll be 3, maybe just 2, and the first one doesn't happen until June or July. I think that's probably less important a driver in what caused the market to roll over today. I think crude prices making a new high over the geopolitical concerns with Israel and Iran likely was the biggest driver. And this is a commodity that was stuck in a range between $70 and $80 for the last 5 months, and just broke out this week above 80 and got as high as 87 on WTI today on an intraday basis. And that typically signals some sort of fear of disruption of supply. So both of those things together certainly delivered a pretty good 1-2 punch for markets that otherwise were doing well this morning.
Yeah, I saw that too. And it also, of course, feeds into the inflation story. So it reinforces all the concerns, perhaps, that he was talking about at this stage. What kind of selling are you seeing? I appreciate it's only, 1.5%, but who's selling? Is this sort of shorter term traders? No one that really has a strong market position is taking chips off the table, surely, at this stage.
No, I think if you look at the inflows that we've seen thus far this year in the first quarter, there's a very broad ownership of equities. But certainly when certain things trigger algorithms, look at things like WTI breaking above 86, making a new yearly high. And that tends to put on a sell program from the algos. And once that starts, it becomes very self-fulfilling. So I don't know that there's a lot of individuals or portfolio managers that are out there and saying, hey, we need to get out of this market. Because of a couple of rumors going on in Israel and Iran, or the fact that oil has finally broken out here. I think it's much more of a fear of what this might turn into. Does this turn into something larger? Does the U.S. have to respond, et cetera? And I think that's why you see the defensive posture and things like gold, certainly in treasuries, and certainly today in energy prices.
So a potential buying opportunity perhaps in stocks? I mean, a few days ago we were talking about the Dow perhaps hitting at that 40,000 level, or to your first point, which I think is really important, watch what's going on perhaps in energy prices first, just to judge.
Yeah, I think that's going to be important. It's interesting. Energy was the worst performing sector in the S&P 500 last year. It's now the best performing sector this year. So it had some mean reversion. But you don't want to see a non-economic spike in energy prices. But I think in terms of long-term opportunities this year, we continue to see surprisingly strong economic data, a surprisingly strong labor market, and certainly earnings revisions that are going up and not down. So I think there's more tailwinds than headwinds right now. But it's also important to note that we haven't had a 2% drawdown on a weekly basis going all the way back to the middle of last October. We typically have 3-5% drawdowns every year. So this kind of volatility is the norm, not the exception, but we've been lulled to sleep because this market's gone unidirectionally higher, up some 25% since the lows of October and up 10% for 2 quarters in a row. I certainly think it isn't hard to find an excuse to take some profits here, and I think this has been one of those weeks where they've been delivered to you, whether it's in higher yields on treasuries or certainly higher energy prices.
Particularly when you've got a payrolls report tomorrow as well. This is why we come to you. That's such important perspective. Sometimes a little bit of a pullback is, one could call overdue and healthy. Thank you so much, sir. Yeah, Art Hogan there. Thank you.